Most people think a company becomes valuable because it sells a lot of products. But that's not how value is created. Some companies sell billions of dollars worth of products every year and still struggle. Others become worth hundreds of billions of dollars while selling far less. So what actually makes a company valuable? Why is one company worth a few $1,000,000 while another is worth hundreds of billions? The answer has very little to do with popularity and everything to do with economics. Because investors don't buy companies for what they did yesterday. They buy them for what they are likely to do tomorrow. To understand value, we need to think like an owner, not a customer. When customers look at a business, they see products. When investors look at a business, they see cash flow. Let's start with the first factor, revenue. Revenue is simply the money a company brings in from selling products or services. Many people assume higher revenue automatically means a better business. But revenue alone tells us very little. Imagine two companies. The first company generates $1 billion in annual revenue. The second generates $500 million. Most people would immediately assume the first company is worth more. But what if the first company spends almost everything it earns? What if its profits are tiny? And what if the second company keeps a large percentage of every dollar it earns? Suddenly, the picture changes. That's why investors focus on profit. Profit is what remains after expenses are paid. A business that consistently generates strong profits is often more valuable than a business with huge sales and weak margins, because profit represents economic value. But even profit doesn't tell the whole story. This brings us to the next factor, cash flow. Many businesses report profits. Far fewer generate strong cash flow. Cash flow is the actual movement of money through a business. A company can appear profitable on paper while struggling to pay its bills. Investors love businesses that generate reliable cash flow because cash creates flexibility. Cash allows a company to invest, to expand, to survive downturns, to acquire competitors, and to return money to shareholders. This is why cash flow is often considered the lifeblood of a business. Now let's move to something even more powerful, growth. Imagine two businesses. One earns $100 million every year but never grows. The other earns $50 million but increases earnings by 30% every year. Which one would you rather own? Most investors would choose the second, because value comes from future potential. A growing company can become dramatically larger over time. This is why investors pay so much attention to growth rates. Growth creates opportunity, and opportunity creates value. But growth alone isn't enough. The next factor separates average businesses from exceptional businesses. Competitive advantage. Some businesses can be copied easily, others cannot. A local coffee shop can be copied. A global technology platform is much harder to copy. The stronger a company's competitive advantage, the more valuable it becomes. This advantage is often called an economic moat. Just as a moat protects a castle, a competitive advantage protects a business. A strong brand can be a moat. A powerful network can be a moat. Technology can be a moat. Distribution can be a moat. Customer loyalty can be a moat. The best businesses create advantages that competitors struggle to replicate, and those advantages often last for years. Now let's talk about leadership. Even a great business can fail under poor management. Leadership matters because management makes decisions about capital, strategy, hiring, acquisitions, and growth. Great leaders allocate resources effectively. They think long-term. They avoid unnecessary risks, and they focus on creating value rather than chasing headlines. Investors pay close attention to leadership Because people ultimately drive decisions. A strong business with weak leadership can lose its advantage surprisingly quickly. The next factor is market size. A company operating in a small market has limited room to grow. A company operating in a massive market has far more opportunity. Think about the difference between a local business serving one neighborhood and a global company serving hundreds of millions of customers. The larger the opportunity, the larger the potential value. This is one reason technology companies often achieve enormous valuations. Their products can scale globally. Now let's discuss risk. Every investment involves uncertainty. The question is not whether risk exists. The question is how much risk exists. Businesses face many types of risk: competition, economic downturns, regulation, technological disruption, debt, changes in consumer behavior. The more uncertainty surrounding future earnings, the lower investors are usually willing to pay. This is why stable businesses often command higher valuations than unpredictable ones. Consistency creates confidence, and confidence creates value. Now we arrive at one of the most important ideas in finance. Investors do not buy past performance. They buy future cash flows. Read that again. Investors do not buy the past. They buy the future. When someone purchases stock in a company, they are making a bet about what that company can earn in the years ahead. That is why expectations matter so much. A company can be profitable today and still lose value if investors believe future growth will slow. Another company can earn very little today and gain value if investors believe its future is extraordinary. Markets are constantly looking forward, not backward. This is why valuation is often misunderstood. People see a company's market value and assume it reflects current success. In reality, it reflects expectations about future success. The most valuable companies in the world share common characteristics. They generate profits. They produce strong cash flow. They grow consistently. They possess competitive advantages. They operate in large markets. They are led by capable management teams. And they manage risk effectively. These are the foundations of value, not hype, not trends, not social media attention. Real value comes from the ability to create economic value year after year. The people who understand this stop looking at businesses like customers. They begin looking at businesses like owners. And that shift changes everything. Because once you understand what makes a company valuable, you begin to understand what creates wealth, not just for businesses, but for investors and for society as a whole. The next time you see a company worth billions of dollars, don't ask what products it sells. Ask what makes it valuable, because that's where the real lesson begins.